Yes, there was the US ambassador who came out and said that we had offered or provided weaponry to Russia. So NATO or could impose sanctions on South Africa. That was quite a heated debate on Twitter as well. Obviously, AGOA, which allows us free access or duty-free access to the American market, was also on the table. Do you think that's still likely to materialize into anything?
Yeah, I think that was certainly what's caused the recent rand weakness, and the sanctions insight definitely. That was a very real risk. But then the guy came out and he sort of retracted it. So it's a bit of a backwards and forwards thing. But these risks are the most important risks to consider in trading. These kinds of risks that you guys are referring to. These are the black swans that will surprise you. Suddenly the rand going to 25 really would change South Africa a lot. It would vastly increase the petrol price, that kind of thing. So which would then increase the price of everything because everything is transported. It would also increase our import costs. If you wanted a TV from Germany, it would cost, say 20% more than it did the year before. That kind of thing. Holding rand hedge stocks in the beginning of the interest rate cycle. Yeah, I mean, dollar is definitely where people go in a time of crisis. I think it's one of the reasons why the dollar is so strong at the moment. They go to gold. They go to volatility. You never want to be against the dollar. It is the most powerful currency in the world, and it is strengthened by unfair variables. So it's always got a tailwind. You might, in easy equities, you're able to trade dollar-denominated stocks. You're able to trade European-denominated stocks and South African-denominated stocks. So if you take a liking to trading, you'll be able to maybe use one of our local platforms to get that exposure to those foreign companies and currencies and hedge yourself in that way in the real world. How do I choose perfect entries? Well, yes, I wouldn't consider that a requirement to successful trading, believe it or not. Your entry price is not nearly as important as your cost price, and they don't have to be the same thing. If you buy a share at 100 Rand and it drops to 50 Rand, it depends on how much you put in at 100 and how much you put in at 90 and 80 and 70, and how that average cost was distributed between your trades, giving you a netted out lower cost price in the future. So I really wouldn't try to time stocks to an absolute T. It's a mug's game. Everyone who trades for any meaningful period of time knows that. Risk management is where it's at. It's the only place it's at. You go buy a stock that you think is temporarily downtrodden, that's got good fundamentals, but at the end of the day, when you buy the stock, if you don't do it with proper risk management principles that involve you having the ability in the future to manipulate your cost price in your favor. It sounds complicated, but it's not. If you buy a stock at 100 Rand with half your money instead of all your money, and then that stock drops to 50 Rand, you've still got another half of your money to put in. Now your new reality, as if you had bought it just today, would be 75 Rand cost. And it is a heck of a smaller or shorter journey to break even at 75 than it would be at 100. So take an active management approach. When you trade in the real world, take an active management approach to your cost price. It is not some passive fire and forget thing. You can very aggressively, actively, and certainly, because it is a mathematically specific process, you're able to drop that cost price in your favor until such time as the stock returns to your cost and surpasses it. Should your cost get back to the original entry price of 100, you would already have made 25 bucks.
Okay. Do you believe that South African stocks are priced correctly in terms of reflecting the true value of their companies?
It's a very long-standing debate, theory called modern portfolio theory versus the concept that markets are not efficient. So many proponents saying that markets are efficient and that it's not possible to get an edge in markets. And then you get guys like Warren Buffett to create such a disproportionately enormous amount of wealth. He almost proves that that theory just simply can't be true. I personally believe that they're a little bit both right. I think that it's not that the market is efficient or inefficient. It's simply that if the market is to be efficient in the short term, which I find it is, that must by definition make it inefficient over the long term. So if a stock in the short term reacts aggressively to the downside because some terrible thing happened, that's pretty efficient. But perhaps that thing is not enough to sink the company, and over the very long term, it's actually worth far more money than it's currently been priced at. So in that case, both parties are actually correct. And the trick is to buy the efficient short-term problems in the hope that the positive long-term outcome will eventually come to light. I saw a question here. Someone asked what a black swan is. During the age of exploration, when some old man went to Australia, he found a black swan, and at the time in science it was considered they just didn't consider it possible that a swan could ever be black. So they found one, and ever since then they've used the term since a gentleman, Nicholas Taleb, he wrote a book called The Black Swan about any event that is it's an unknown. So it's some random thing that could just suddenly come out of the blue and wipe everybody out. Very good example of a black swan was COVID. Nobody saw that one coming. There are, or the 2008 subprime mortgage crisis. There were some people who saw it, but for the most part, it was a black swan. And those black swans, because everyone's positioned completely the incorrect way, having no idea what's about to happen, always results in the most market movements and the most volatility, because the equation has to rebalance again. And now there's some terrible new variable involved. Or it could be a positive variable. It could do the same thing to the upside. If you get in those, you're lucky. But, it's not really a consistent way of making money.
All right. All right. Do we have any other questions? Okay, guys, thank you so much. This has been such a wonderfully interactive session. Thank you so much for joining us this evening. Oh, yes. He is a genius, but where did you learn this stuff?
I learned it out of necessity, actually. I think I got involved a very long time ago. I just got involved passively in stocks. So I had things like endowments, and I had the more traditional stuff, and they just kind of weren't doing it for me. So I kind of took the reins myself, and then I learned. But I tell you, I learned, read many books in my life on this subject. I've seen countless hours of material. But trading in the real world is what teaches you to trade, just like doing anything in the real world. It's literally a case of just get in there. You don't have to take your life savings. Just put it in there. Try to figure out just the basics of it, like driving a car. You don't have to be a Formula One driver. Just get in there and drive your little skedonk around until you get the hang of it. And then if you really get the hang of it, you'll be driving a Ferrari.
Awesome. Precious metals like Anglo-American platinum, Anglo gold.
Yeah, okay. Platinum is the largest export in South Africa. It literally pays for everything around here. We have a couple of we have a few large companies in South Africa. We have Anglo American Platinum, we have Sibanye Platinum, we have Impala Platinum, we have RB Platinum, and we have Tungela Platinum. So we have plenty of platinum companies. That's because we have 80% of the world's platinum. And if you want it, you've got to get it from us. So those guys export, it's a beautiful, amazing metal, wonderful value, it holds value. And the world needs it. They'll tell you that electric cars are going to stop the world from needing platinum in the next 5 minutes. And they've been telling me that for like the last 30 years. And here we are. It's still the biggest export. So I think they're fantastic companies. They run very well. Question is, should you buy them now? Who knows? They're making a lot of money on the rand weakness, though. That's for sure.
Passive income is a necessity.
It is a necessity because it's like having another. It's like having you get like another spouse bringing money into the household when you've got a portfolio. It's a third party, and it's independent of you and all your problems. It's really a useful thing. And you can, with these facilities nowadays, I mean, it wasn't like this in the old days. The old days, I used to call in my trades. Now you can buy Growth Point properties, for example. It's got the Cape Town beachfront. You could never, well, let's not say that, but for the most part, we could not have built businesses independently of that scale. But the market allows you exposure to that incredible opportunities. I mean, you would have no chance of repeating. They were built. Those companies were built in a different time. They were built with a different set of circumstances. It'd be very hard to replicate them now, but yet you can still get exposure to them as if you started them to a smaller extent.